Investors, welcome back to the deep end, another episode here. And this episode is actually, I think, going to be one of the best episodes yet because we have a special guest on with us, Mr. SCHD, Craig Sutton, on with us in the deep end. And it is such an honor to have him on because we're now going to talk all about, of course, dividend income, his journey as an investor, and being the first guest. Craig, I want to pass it right over to you. How does it feel to be in the deep end with us?
It's awesome, man. Thank you so much for inviting me. I listen to, it's one of my favorite things to listen to. I listen to listen to every one of your shows. So it's an honor to be here. I really, it's fun. I like this authentic, just firing things off the top of the dome. And I appreciate how fired up you guys get, especially you, Ari. You've been on fire lately, man. I love it.
Ryne keeps me pretty tame. I gotta cool it down a little bit when I get too heated. Thankfully, I got Ryne.
No, man, we balance each other out really well. It's been a lot of fun so far. Definitely fortunate to be able to do this, and Craig, we're honored to have you on as our first guest, man. So thank you so much for taking the time to do this today.
Appreciate it,
guys. I want to toss the first question out for everybody, actually, and I mean, there's been a lot going on recently in the stock market. We've been in the green zone now for a couple days. How are your portfolios looking? I guess, Ryne, we'll start with you and bounce over to Craig.
Dude, I am currently sitting at all-time highs in the portfolio. We're about $2,800 away from that 100K mark. And I honestly don't even want to talk about it too much because it's going to jinx it. I was joking with a couple people just in like DMs and on Blossom yesterday too in the comments, which actually, by the way, guys, the deep end is brought to you by Blossom. If you guys are not over there yet, if you're not on Blossom, definitely check it out. It is the place to be for investors, and you can see all of our portfolios. I think, Craig, you're even on there too as well, if I'm not mistaken. You're just SCHD Stan on Blossom, right?
Yeah, that's right. Yeah, I need to get more active on there. It's a great platform. I should definitely use it more, and I probably will after this.
All right, good. But anyway, guys, if you want to check that out, there's a link to it in the description of the video or in the pinned comment or in the show notes, depending on where you're watching and listening. But yeah, what I was going to say was I don't want to talk about it too much because I think it's just going to jinx it. But yeah, that's where we're sitting right now. I'm going to leave it there, and I'm just going to let it do its thing. Just do your thing. Anyway, Craig, where are you at, man?
Yeah,
What's going on with you?
I feel the same way. I really don't like taking note of all-time highs because as fast as they come, they go just as quickly. So you can't get too high and you can't get too low when it comes to this investing. So I see it, but and it's there, but I don't like to pay too much attention to it. And honestly, I do look at SCHD every day. I'm on X and I'm reporting the opening, the close, the midday. But honestly, I don't really care that much about day-to-day moves. I really don't. I care more about the long term. So everything I look at on a day-to-day basis is very fleeting because I just know it could be up one day, gone the next. So yeah, it's hard not to get excited, but at the same time, I kind of got to mellow myself so I don't get too down when things go bad. And that's kind of how I stay in the game and remember to buy when things are down. I can't get too excited when we're up, and that helps me deal with the down.
It's such an interesting thing because in having these conversations about, being at all-time highs, having the highest market value in your portfolio, on one hand, it's cool, right? This is the most amount of money I've ever had in this account. But then again, and I get into this conversation when I talk about this stuff with the people who are, we're talking about the all-time highs. Because on the other side of that is well, yeah, but that, you actually shouldn't be too happy about that because you would rather actually be at all-time lows so you can buy more things at a discount so you can get more bang for your buck. So it's kind of hard to reconcile those two opposing ideas because it's hard to reconcile, but it's also, I guess, kind of a good thing because no matter which way you slice it, there's some good to be found in it. But I don't really know. I don't really know which one's better. I'm excited to see the all-time highs, but also would not mind being able to buy stocks for cheaper. So I don't know where you settle with that.
Right. I feel like you're winning.
Yeah, I'm the same way.
You're winning all the time.
I look at it like a vantage point. When we reach that high, I'm like, oh, we got here. So now I'm standing here. and the next low that we get, I'm still on that high, looking down, knowing we're going to come back up eventually. So I get excited for a split second, and then I try to tone it down a little bit to say, like, I know the future is going to hold some volatility for us. So be prepared for it. Celebrate that, that high, that good feeling, and then wait. Right now, even my portfolio just hit over 270,000. So,
Dang.
I had a moment where I, threw my hands in the air. I was like, let's go, right? And but then I pulled it back. I'm like, all right, hopefully though this week we get volatility, because Ryan, as you shared, it's all about buying on the lows.
Yeah, absolutely, man. Absolutely. Craig, I think you were going to say something a moment ago, right before Ari jumped in there.
Yeah, well, I just want to say it's just like, to me, it's like you're winning either way. So if you're down, it's a great opportunity to buy. When you're up, it feels good. You're like, okay, well, this is why I'm doing this. You get a taste of like the future. Like, this is what even a short-term gain can look like. So what happens over a year, 2 years, 5 years, 10, 20, 30, right? Like, it's just going to be compounding way beyond that high that we have today. So it's really motivation. It's motivation either way, right? Because we know, like, I think, Ari, you just said too, when you're down, you're going to get back to this point, right? That's the mentality you have to have.
Yeah. Go ahead, Ari. Were you going to jump in?
I was just gonna say,
Okay.
I got to get to this.
Okay.
So here's the reality to everybody listening. Last week, Ryan and I concluded the last episode, and we were like, man, we got to get a guest on here, like just a good guest to come on and rev up some new energy here in the deep end. And we started thinking about who to invite, and it was a no-brainer for us. Like, Craig's been on our list for quite some time. And the moment we were like, yeah, SCHD Stan, Ryan was like, I got the perfect question to ask. Oh. And so I'm a little bit excited to hear what the question is and Craig's response. So Ryan, what has been that question you've been holding back on now for about a week?
Yeah, so this actually ties in perfectly to what we were just talking about. I got this question from my friend Diego, who I'm sure Diego's listening right now. So Diego, thanks for the great question. But he asked me, how do you feel about all the recent SCHD slander? Craig, I know you've seen it. Ari, I know you've seen it. Craig, I think you've even talked about it on Twitter, on X. I've seen some of your posts, I think, kind of mildly addressing this. But I want to pass this over to you and get your thoughts on this. How do you feel about all of the hate towards SCHD? It's been getting, at least so far this year, but possibly even longer. I've seen it more prominent this year. Yeah. But what do you make of all of this?
Yeah, well, it's so normal when something like SCHD has underperformed for the last little bit, and to me, that's exciting to me. Like we talked about, when something's down and it's still good, that's when you buy. That's when you want to get excited, and people people want to ride a trend and they want to buy what's flying high, and that sometimes that works. But oftentimes that doesn't work. That's not what you want to do. And I just feel like no matter what happens in the short term, in the long term with SCHD, you're going to get market-like returns. So if that's the case and we're underperforming the market, that's just a gap that's going to get filled eventually. Like, let's just say the market returns 8 to 10% over the long term, right? Always. I just feel that SCHD is going to be close to that, maybe a little under, maybe a little over sometime. It's always going to be there. If you get these years of underperformance, you'll eventually catch up, and it all just levels over the long term. So what has the better opportunity? Right now, buying something that's still down like 10% off the highs, or buying something right at the highs where the market is, right? So, I feel it. I definitely feel it, because people reach out to me every day on Twitter about this and say, why are you so excited about this still? Why do you buy? Why are you, you have this many shares? Like, time is like, when I hear that, people tell me, why haven't you sold this yet? You're still buying this when, when just buying the S&P, you'd be doing so much better.
Palantir.
And it's true.
Yeah.
But to me, it's still exciting, and it's not my only investment. Like this, I use it to balance out the tech that I have, the growth that I have, all the S&P 500. It's just a piece of the puzzle, right? And people always want to be like, it's like they only want to buy one investment. Like we only buy the S&P 500, we only buy the Qs. It's not this or that. It's and to me. So yeah, I mean, I could
Yeah.
probably go on for days about this, but that's the basics of it.
That's a great point, man. And I think it's, where do I even start with this? Because I feel like we could spend the whole rest of the hour talking about this. You know, up until recently, I don't know when exactly, maybe this last year, these last couple of years, you know, prior to that, SCHD had a killer run. Like there was a long stretch of time, I believe, correct me if I'm wrong, but there was a long stretch of time where it was actually outperforming the S&P 500.
Yeah.
And people loved it for that. But you know, I with that said, I don't know that it's entirely fair to expect outperformance all the time. And this isn't just specific to SCHD. This is specific to any sort of investment you hold. There will be times where that investment, whether it's an individual company or a fund, you know, it's just kind of like, you're just kind of like poking the stick, waiting for it to move. There's just going to be times like that. And to your point, that's why you don't have just one investment and one investment only. Same thing, whether it's just one individual company or just one ETF. I guess you could do like VTI and call it a day. But even within that, like even within that fund, there are stocks that are performing better than others at any given time. And we should expect the same to be true across different funds if you've got a couple or a few different ones in your portfolio. And so, yeah, it's been interesting to see that. How do I say this part? It's been interesting to see people who formerly loved SCHD as a long-term investment. Now, when in recent times, in a short period of time, it's not doing as well, have a change of heart. And I think that speaks to how hard it can be to maintain a long-term mindset, especially when you're comparing asset A to asset B, the SCHD to the S&P or, you know, something else. And so it's just been interesting to see this play out. But there's more that I want to say, but I wanted to take a beat there. I think, Ari, I saw some head nods. Maybe you've got a reaction to some of that stuff. I want to give the floor over to you because I don't want to keep hogging it.
First of all, I really love what Craig shared, that people are chasing trends, and it's so true. But you know what? It's so true that oftentimes we hear that saying thrown around, the trend is our friend. And maybe that gets into a lot of our heads in a negative way, because again, you look at some of the best investors of all time, and these guys really are all about find the quality holdings to hold. And so at what point does the trend is your friend work effectively, and when does it work against you? I'll throw that out there for the both of you.
Yeah, I mean, it's interesting, right? I mean, you see the studies that are done. Oh, sorry, Ryan, take this one because I got something with the kids. Go ahead.
Oh.
I'm going to mute myself for a second. Go ahead.
So when is the trend is your friend? When is it your friend, and when is it your enemy? Well, I guess the trend is your friend if you're going with the trend, right? Yeah.
But it's like at what point do you stop playing that game and like chasing the trend? Because to Craig's point, it's like you have a fantastic ETF. It's going to work for you. But all of a sudden we get a streak of, you know, a couple bad weeks, a couple bad months, you know, maybe a year. But we ultimately know that this is a solid fund. And so when did that chase just become your foe?
Yeah, well, I think it can really, what it boils down to, man, is what are you optimizing for? Are you looking at investments based on the price action and using that to drive your decision? Like, in other words, are you buying a stock just because you see it going up? We know a lot of people. I mean, there's a whole investment strategy based around that. That's basically what momentum investing is. And so are you buying a stock just because or an ETF just because you see it going up, or are you buying it because you like what's under the hood? And I think you could really put yourself in a bad spot if you're buying it for the former versus the ladder. And with the ladder, if you're buying something for what's under the hood, for the fundamentals, it's a lot, you have a much greater appreciation for it. And furthermore, you know why you're buying it. You're buying it for the qualitative aspects that it brings. And I think that definitely applies to SCHD. And I'm surprised Craig hasn't said this yet. I'm surprised Craig hasn't said this yet, but it really just comes down to like the fund objective. And that's why that's what you should hold on to during these times when the trend might be your foe or when it might be going against you. You have to go back to your why. And that's something that we've talked about at length here on the show, right? But I think that's what it comes back to.
Yeah,
Greg, what do you think?
Yeah, I think people forget that there are times when growth isn't flying high, and there can be really long periods of underperformance when no one wants to own those things that are growing so quickly at this moment. And SCHD is built differently and has more of a value tilt that holds up so much better in those times. But and we say that a lot, but what people also forget is that when interest rates were much lower, SCHD actually, Ryan had mentioned this, had outperformed. And what's interesting is, when was the growthiest time recently? It was like 20 after COVID through 21. You know what? And SCHD actually outperformed the S&P 500 during that time. And I think so many people forget, and they think this thing so great. It's better when things go bad, but when things are great, let's not have it at all. Well, in fact, at that time when growth was like the highest performing thing, SCHD outperformed. It's incredible. That was a certain atmosphere that we don't have right now, but that doesn't mean that something similar to that can't happen again. And I'm not saying that SCHD will always outperform or that it will outperform. But what I'm saying is we don't know. So you can't just sit here and say, going forward, why would I ever buy SCHD? Why would I not only invest in the Qs and SPY when I know because of the last 3 years it's outperformed? That doesn't mean it's always going to outperform. Like every time people talk about this stuff, they say, past performance is not the indicative of future success. That's it. It does help. But you can also go back and see that, especially if you go all the way back to 1999, the index that SCHD follows outperformed even the Qs from 99 all the way through to, I want to say, about 23, 24. So, I mean, if you do want to look at the past, look at a longer period like that. And it's pretty incredible. And it just goes to say what I said in the beginning, is that just over long periods of time, these things tend to even out. So it also means that we can't lose. You buy good things and you're going to win. It's about investing. Whether you're investing in SCHD, if you're investing in the S&P, you're investing in the Qs, these things, you buy them, you hold them, we're all going to do well.
Yeah. Yeah, that's a great point, man. And I think part of it too comes back to talking again about knowing your why behind it. I think part of it comes back to reminding yourself, why am I buying this fund in the first place? Am I buying SCHD with the expectation that it's going to beat the S&P? Am I buying it because I think it will, or am I buying it for other reasons? And this goes to an even deeper question. But anyway, before I even get to that, are you buying it for its outperformance, or are you buying it more so for the growing dividend income and the decent returns that it should definitely offer if it's paying a dividend and also growing that dividend year in and year out? So why are you buying it in the first place? And if it's not because you want it to outperform the SCHD, if it's more of like a growing income type thing, which I think is the case for probably a lot of us, it'd be nice if we could have the best of both worlds, but I think a lot of people probably prioritize like the income and the growth of that income when it comes to SCHD. And so if it's still doing that, why question it? Why be so upset about it? Number one, but number two, like I was saying, that begs an even bigger question, and I'd be really curious to get both of your guys' thoughts on this. It ties back to that we've always hear get thrown out, that total return is the only thing that matters, and we've probably talked about that before. We've probably thrown that out ourselves, but I've been thinking about this a bit more, and I don't know. I just question: is it really the only thing that matters? as investors, are there other ways to measure our success? What do you guys think about that?
Yeah.
This actually goes hand in hand with a question that I was going to throw in the ring for us. But, taking a look at someone's investor profile, which I always go back to. I mean, we talk pretty extensively about knowing your investor profile. But being a younger investor, when SCHD, or let me go with these growth ETFs that are out there, or growth stocks even, when they're not doing so hot and SCHD is, and knowing a younger investor has a much longer timeline, should the younger investor be going with the SCHD safety, or should they actually be throwing more money towards the growth-oriented ETFs or stocks that are hit hard when SCHD or the alike is performing well? Because if we are talking total return, again, it's all going to go back to that profile, your goals, what your strategy is. Those are all like the main frame questions that you have to have answered before you even invest. I don't even know if a lot of people really sit with themselves with, like, again, I'm old school, so notepad and pen, and go through like some real questions with themselves. Because when you get in the game, any sport, there's a playbook. And so what's your investor playbook? Are you just going to get on the court or the field and run around and flail your arms? No, you have a playbook. You know the plays. And I feel like with investing, sometimes it doesn't work like that. People don't even know who they are as an investor. They just, catch whispers or hear the noise and invest somewhere. And it really could be, I feel like even younger investors, if they come across, Craig's SCHD Stan account, or Ryan, your account, or my account, and they're like, oh, let me just throw the ball in the ring and do this. And I just feel like we're really actually failing before we even can get to a question like this. I'm like, who are we? Let's ask that question. What really are the goals? Yeah. Is this ETF or is this strategy good for me?
Yeah, that's a great point, man. And we definitely talked about this before. And it's so hard. Like, as a brand new investor, you just don't really, number one, I don't think you really know to ask those questions. But even if you did, you don't really know how to arrive at the answers. And I'm gonna tie it back to like weightlifting, right? So like, someone is just getting into the gym, and I won't ramble on this, I promise, because I want to hear Craig's thoughts. But someone's just getting into the gym. They want to build some muscle, right? They know that that's kind of their goal, but they don't really know. I don't really know how to do it. I don't know what the right way for me to do that is. So let me just follow this person. Let me just follow this person that is like looks like how I want to look. Let me just model what has worked for these other people. I think, and then you kind of come into your own from there, right? You learn the basics. You learn you just learn how it all works. But it all starts from modeling what you see other people doing. And I think that same type of entry happens here in investing, and probably it happens with a lot of different things, different crafts. It probably happens with running, and I'm sure it happens with a lot of different things. But I don't know. I definitely think we see that play out in investing, especially because it is so complicated and so many people don't know where to start. Does that make sense?
Oh, for sure. Yeah. Well, it's just funny because I think about, when someone goes to the gym, and I used to be a sales director at a Jersey gym, and 9 different locations, and training people on how to sell the gym packages, how to sell training packages. It's just funny because when you really, whether it's the gym, sports, investing, like, how naive is it? And we can give, I just don't like to give excuses out, but we can do it for the sake of this, right? I'll be a little lighter today.
we have a guest, so we need to be on our best behavior, right?
I'll keep it tamed.
Yeah.
I just want to say that, how naive is it really to go you can go to the gym, if we run with this analogy, and look at the Hulk Hogan over in the corner throwing dumbbells around. But it's that same guy who sometimes throws out his back because he's actually squatting with improper form. So it's just like, how do we really want to go about this? We can make choices from the get-go to set ourselves up and be on a better path. We don't have to be so naive.
That's true. That's very true. Very true.
Craig,
What do you think, Craig?
We got to pass this over to you, though. We're too silent over there.
All right. Yeah. Sorry.
What's your 2 cents?
I got the kids are on, just got off vacation. My wife had to head out of the house, and I'm home, and there's kids over, and there's parents picking up kids. And it's chaos. But yeah, so just circle me back. What were we talking about? And then I'll jump in.
Well, like the original question, this all started because I asked the question, like, why are you buying SCHD in the first place? And that tied into, is outperformance really the only thing that you should be looking for? Is that the only thing that should matter to an investor, or are there other things that we need to take in consideration? Right. And can those other things be found in an ETF like SCHD?
Right. Okay, absolutely. Okay. It's a great question. It's something that we all think about and some struggle with. And that's why, to me, it plays an important role in the portfolio, not everything, because you may not get the kind of growth that you could get, especially if you're a younger person. So it's good. But, people always talk about owning bonds, right? Like how much your percentage should be a bond to have like that safety net. Well, Warren Buffett called this type of investment, he didn't say this about SCHD, but he did talk about equity bonds and having, a solid company that is like an equity bond, something that grows and capital appreciate and can appreciate, the dividend can appreciate as well. So you get the best of both worlds. And that, to me, SCHD is a really safe way to do it, because you're getting 100 stocks, you're getting it diversified, you're getting something that for 13 straight years has grown its dividend every year, and it's not just depending on the organic growth of those stocks, although that is usually pretty strong with the way that it selects stocks. But you're also getting how they will every year, they'll cut out lower yielders and add in higher yielders, which also gives the yield every year typically a pretty good boost. And that's why you've gotten that, like, starting like I'm talking about over the history, like high twos, which is in the past, to mid threes, to now 4% yield starting. But on top of that, an 11% growth rate every year. You're not going to find a stock that can do that and do that sustainably and reliably. And the point of like dropping all those stats is to tell you that if you buy something like SCHD and decide, you know what, I'm never going to sell this, and I just want that growing income that it's spitting off to rely on if I lose my job, if I want to retire early, or if I want to retire at 70. That thing is growing in the background. That income is growing in the background. And then, Ryan, like you alluded to, do you care then if the price goes down? If the price is not growing as much as other things? If that income continues to grow and you see, hey, it's starting to get to a goal where I can retire because this thing is going to pay the bills. And not only that, it can not only keep up with inflation, but way surpass inflation, right? So there's a whole other way to look at it. And the way I look at it is that I am never going to sell these shares. So I don't like when it's underperforming for 4 years, but I still see this as a great opportunity to buy because I'm just getting it at a higher yield. And that yield is still growing at 10%. And will it always stay at 10, 11% growth? No. I think it'll probably level off over the years. Same thing as the appreciation, probably around 8% or something like that. But that is still incredible. 8% income growth, you're not going to get that at a job every year. No way.
Yeah, especially with a 4% starting yield.
Exactly.
Those two combined are just incredible dividend stats. Incredible.
Yeah.
Craig, what would you say is a good, I don't want to use like cutoff age, but like what are some good age ranges where you think someone should be more aggressive with this fund and where somebody should be less aggressive with it?
Yeah, I mean, it's really going to be very personal, but to give like a general answer, like maybe when you get into your 40s, like you could start like being a little more aggressive into something like SCHD, but it's really up to your, like, it's up to your own personal choice. Like look at what Ryne has done. Like Ryan's a young guy, and he's like not just SCHD. Like he's really focused on dividend growth. And correct me if I'm wrong, but I believe Ryne, you only invest in dividend stocks, and it's worked out really well for him.
Yeah.
Like he's often ahead of the market, only picking dividend stocks. Right? There are some amazing dividend growth stocks out there that are some of the best companies, the best investments around. Now, if you're asking particularly for SCHD, it is a little different because it does tend to sell off the ones that are outperforming because the yields get too low. But again, that tends to average out over time, but you will miss out on some massive growth spikes like year to year because of that. So yeah, I wouldn't personally, I started investing in SCHD when I was about 40, 41 or 42 or something like that, right? So if you look at what I've done for myself, I would say that was probably a good time to start. And then I've ramped up a lot over the last, whatever, 8 years.
See, it's interesting because you said 40 plus is like, that's your time to get more aggressive with SCHD. And then you kind of just circled back to that and saying like, that would be a good age. So my question, and I guess we could jump over to Ryne even because you're invested in SCHD. What do you think about that, being a younger investor and below 40? My thoughts on it are kind of like, I feel like everyone knows where I'm going to go with this, but like be a little more growth oriented while you can be, because there's only a finite amount of time you're going to be able to take on some legitimate risk. And that time is when you're younger. It's certainly not when you're older.
So I don't, no matter how old or young I am, I don't know that I want to take on risk. For a couple of reasons. I mean, number one, I just don't want to. Actually, let me think about this more for a sec.
Let me also say, when we talk, I feel like when I talk risk, I don't even talk like legitimate risk, like leverage, and I'm talking just like more growth oriented, individual stocks, less of a dividend yield. They could still pay a dividend, but when we talk about like the legitimate safety of like an SCHD, it's totally different. And that's where I feel like we find a lot of young investors who are almost doubling down on these types of real safe, risk-adverse type of plays, which for me, and again, I always go back to like, where did I start? I started with a VTI, and then I found my way into dividend stocks. And, at some point, a couple of years ago, I was like, wow, like, man, you're playing it too safe. And this is your opportunity now because you have this time to take on some more risk. And to Ryan's point, what he just shared, right? Like, well, I don't know if I want to be too risky. I don't even look at my investments as risky bets. Like they also have to meet some pretty strict criteria. I'm not investing in penny stocks. I'm not investing in option-oriented ETFs. Right? It's a pretty, I think, secure portfolio. And where the risk will come from for me is individual stocks with less of a higher dividend yield and more of a growth orientation.
Yeah, I think at the end of the day, what you want to invest in is quality, whether it's labeled as growth or dividend or value. You really want to look for quality, and whether that might come in a lot of different ways. And to me, that's the most important thing. And I think you guys have dove into this before because this is really, you two, your different strategies where they kind of butt heads. It's like at the end of the day, I think we can all agree on that we want quality, and it's quality that's going to do well over the long run, right? So, and by no means did I mean to say like, your point was asking me like, when did you get more aggressive? Not when would you start? Like, I don't think there's anything wrong with somebody that's in their 20s buying SCHD. Myself, I would do a little. I would probably focus more on more growthy stuff though when I was 20 in my 20s, which I did. So, but having something at 20 years old like SCHD that grows at 10%, the dividend, that thing is going to be paying like a beautiful snowball in 30, 40 years. So there's nothing wrong with that at all.
Yeah, honestly, sorry. Oh, sorry. Go ahead, Ari.
I was just going to ask, would you say like Craig, like 5% in your 20s, 10% in your 20s? Like how much of an allocation would you divvy out to SCHD?
Oh, now you're putting me on the spot. I mean,
Just that's because we have such a wide range of viewers, so it's always interesting, and you are the SCHD guy. So I feel like I got to ask this question
yeah,
to
no,
you.
I think there's nothing wrong with like 20, 30%. Yeah, no, nothing wrong with that.
What's
Yeah.
the variable though? And maybe we kind of touched on this. What's the determining variable? Is it's because it's not just age, right? There's definitely more to it than that.
Right. Like,
So what are some of those other things?
yeah, like you talked about your risk profile, right? Like, what are you looking for? Like, one of the reasons I first got into SCHD for myself, it was like, okay, I have a little bit of money now and I don't want to lose it. So let me
Yeah.
look for something that's not as, like we said, risky, like that holds up better. That was part of the reason I went into it. So that doesn't mean that someone younger can't look at it that way and say, you know what, I'm not willing to take the kind of risks, the high reward and high risk. Let me take something a little less risky, a little less reward, possibly. But again, over the long haul, I don't see it. I'm like contradicting myself all over the place because I do see it as
I know
is doing quite well over the long period and being very similar. But it's kind of like, how are you going to get there? It's like less of a roller coaster, which might help you stay on track. So maybe it ends up being better because you don't panic and sell out because you're not going on that wild ride every 3 years.
That's what makes this such a hard conversation to have, is because it's not, and this is true with anything in investing, it's not black and white. Like there's so much gray area. And in so many ways, the answer is just, well, it depends. And that's why, personally speaking, I try and build this all-weather portfolio where I have the SCHD, but I also have the VOO that offers what SCHD doesn't, and vice versa. Right. And on the individual stock side of things, I've got the high yielders, I've got the low yield growth ones. But all of that is an attempt to build this all-weather approach that where no matter whether momentum's your friend or your foe, you've got something going on. Something's going to be up, something's going to be down. And I think, kind of going back to what we were saying earlier, that's just going to be, I don't know, that just comes with the territory, I guess.
Yep, I agree.
Yeah.
That's interesting. I mean, I just always think about it, like, even for myself, about a decade's worth of time invested, and I'm like, what would I do differently? And you can never change the past, right? But I can always try to help people avoid what I feel like was a mistake, or and Ryan, to your point, like you do have to take in the risk profile, because like now, and this is where, like Craig said, I don't want to say we even butt heads on it. Someone actually commented last week.
We get comments saying we do, but I really don't feel that way.
Well, someone commented like, "Why is Ari always trying to change Ryan's strategy?" I was like, "I'm not trying to change it. I'm just trying to challenge him a little bit." But it's also how you get people to come around to just viewing things in a different perspective. And does it change them? Maybe. Does it change? Like, maybe it doesn't, right? But at the end of the day, you need to have these conversations. And I feel like something that's important is, as an investor, we have to be willing to mend and bend and adapt and grow and call ourselves out. And I'm constantly trying to do that objectively on myself, right? Like, how do I call myself out? How am I going to make myself better as an investor? And one of those things was, okay, when I started dividend investing, my risk profile, I was so risk adverse. Why was I that risk adverse? And then it turns out, when I dig deeper on some of those questions, I was so risk adverse because I didn't know what some of the other opportunities were going to offer me, and I didn't know that what I thought was riskier actually wasn't as risky as I thought, which was it's also interesting to think about that. I just never ventured down the growth lane, if you will, or the path, because what I heard from all the noise was like, growth equals risk. Well, not all the time. Like, when you're investing in some of the Mag 7s, like, let's just take your Apples, Microsofts, Alphabets, like, Amazons, I don't really see those as risky bets.
Yeah.
Yeah, well, not anymore,
Yeah,
right? They've
absolutely. Yeah.
matured to the point where like even some of them now, a good chunk of them now pay dividends and like have started to mature, right? And that's kind of like, and if
Yeah.
they're not yet, they probably will be soon. So to me, like that's a really nice company that's done so well that they've matured and they're more stable. They pay a little dividend that's growing. Like to me, that's a really nice sweet spot. And I think people forget that the best companies in the world tend to pay dividend and they've been around so people understand like they can survive the good and the bad. See, where I think people get a little too excited is some of these newer companies that everything sounds great because they're doing well right now. And but nobody talks about the issues when they're flying up. Like when they're up 100%, it's people are so like it's the price that drives the sentiment and everyone's saying nothing but good. As soon as like the growth goes down just a little bit, people start asking questions. Oh no, we're not going to get our 30-20% growth like in their revenue, right? Like revenue growth starts to slow. All of a sudden that price is just going to get killed, right? And people just forget that so quickly when things are good. And like I don't know, like examples like the SoFi's and like Tesla and I invest in some of these companies too. Like I bought Tesla a long time ago, so I have such a cushion in there that I'm like I don't care. It's up so much, but I almost bought that. I just got lucky. Like I bought it when I first started picking my own stocks, and I bought it because it was a big name. Like I bought it for fun, and it's up 1,000%. But that's not going to always happen. And back then I was like, I read books about Warren Buffett, and it was buy and hold. So when it went down, buy and hold. I just held. I've done that with like Facebook and all these companies, right? But I've almost got like dumb luck from just sticking to something that I thought was the right thing to do when selling might have been better, but it turns out it wasn't, right? So I don't know. I kind of lost track even how we were talking about, but that's what the deep end does, right? We
But
just
the
go off in tangent.
yeah. Oh yeah. All the time, man. That's what it's for. It's just one big thinking out loud session basically. But, going back to what you were saying there at the end, you thought these things, these investments were the right things to get into. And that was probably less about the direction the share price was moving, and it was probably more so about what those businesses were actually doing, wouldn't you say?
Yeah, definitely. Like it's funny because when I first started picking stocks, I didn't know to look into financials and all this sort of thing. I picked companies that I knew that I thought were doing well and that I understood what they did. And then when I started picking stocks, like getting more into it, and more into it actually meant just listening to the talking heads and still not getting into the finance. And that's when I started buying all these other things. And those stocks all did like eventually came down from their highs. And the stocks that I look back that I first bought that were the Googles, the Amazons, the Netflix, the Facebook, the Tesla, were doing amazing. And I'm like, what am I doing? Like I should have, the beginner's luck was better than when I was actually paying attention. But, at the same time, I wasn't really paying attention to the right things. But I think that's what a lot of people do when they invest. They don't know what to really look at. They listen to other people. And who knows where they're getting their information from and what kind of investor they are. Like you have to understand their perspective. Like I've said this all the time, like these people aren't always right or they're not always wrong. It's where are they coming from? Like what is their bias or what is their strategy? Are they traders? Like they talk up a stock and then they might be out of it in a week, right? Like we don't know. They say something good about a stock and they say they're buying, but we don't know what they do the next week. We don't know when they sell. So you really got to make sure that you're prepared to follow a stock if you're going to buy it and not just listen to someone else and wait, buy on their conviction because their mind could change and you won't know it. So I learned that lesson the hard way.
Yeah, and I think for
I
a lot
love
of
that.
us, like, go ahead, Ari.
Yeah, you go ahead. You go ahead, Ron.
I was just going to say, I think for a lot of us, that's the fun part is dissecting these companies and then just keeping tabs with them after we add them to our portfolios and just kind of following their journey. I think for a lot of us who do invest in individual companies over ETFs, that's where the fun is. And a lot of people look at that and think, why would you spend time doing that? That doesn't make any sense when you can just buy ETFs and call it a day. But, like I said, that's kind of where the fun is. And, for the people who don't find that to be very fun, or if the thought of doing that with the companies they own stresses them out, then, you probably shouldn't be doing it in the first place. Just stick to the ETFs. Don't worry about the stock picking.
Right.
I just wanted to say, I feel like we spoke about this at some point on the deep end, maybe a couple of weeks ago, but Craig just shared it, and it's such a valid point of like, you can't steal somebody else's conviction because you have no idea what happens in the next 24 hours of their life or the next week, like what their investment moves are. And there's so many times when someone is so stoked, so excited. They're the only, pieces of content they're sharing with everybody is all about the hype. And then like a couple of days later, maybe they receive a bit of information or they see something they don't necessarily love and they sell out of the position. And now you're the one, because you stole conviction instead of doing your own due diligence. It's like, oh crap. Like, I didn't hear that piece of news, but you're holding the bag now. And it's like I think one of the most important pieces, arguably the most important point, I think, in this episode, because it even goes back to what we were saying. Are you going to go into the gym because you want to get big or lose weight or whatever it is? Are you going to go in there naively throwing dumbbells around, looking around at, Hulk Hogan to your right or left? Or maybe you can actually ask someone who's had experience and they got to where you want to be. Maybe you can get out of your comfort zone, and before even, just tossing money into the market and stealing someone's conviction, write them an email, try to get in touch with them, or find a community that's talking all about that investment. And I've just found I'm guilty of that too. Early on in my career of investing, it's like, there's so much noise out there.
Right.
And you got to tune that all out and just not be naive.
Think about a situation where you know a lot about any topic, right? Like, let it be cars or whatever it is, right? Like, you know a lot about it, like a specific car, let's say, what kind of engine it uses and how fast it can be, and it's 0 to 60 in this. And then you hear somebody who's just kind of a tourist and talking about that. Like, they really don't know it like you do, right? But they're seen as an expert in another field. So people look at that person and they say, oh yeah, that guy's a smart guy, and he said that this car is good. And you're like, no, I know that car. Like, it's not made for, like, and he's saying it's good to race or something. You're like, no, that car's not a good race car. Like, it's a good, like, cruising car. Like, you know what I mean? Like, people give people too much credit but you only see it when you know what they're talking about, and you know it, and you're like, hold on, that's not true. So then how many times are people speaking that you think they're an expert on it, but it could be that situation again, but you just don't know that topic like you knew the other topic, right? I've learned that so many times. I'm like, hold on, I actually know this, and that is not true. Like, they're talking about Google, like a company I follow, and like I still do. I work in like search engine optimization and stuff like that, and things I know about search engines and Facebook and these things like that. And it's like, wait a second, that's not how that works. Like, and that person is spouting off like they're an expert, right? And it's not it, So how many times is that happening in our lives?
It's happening a lot, and I think at least in our space, just on social media talking about this stuff, I think oftentimes a certain subscriber count or follower count is misconstrued as, expert status. The more subscribers you have or followers you have, the more knowledgeable you are. And I can't tell you how far out of my way I go to try and avoid that. Like, I really want to, as much as I can, drive the point home that I am by no means any sort of expert whatsoever. I'm just a mere enthusiast of this craft. And I just, that's all I want to be. I'm someone who loves it. I love doing it. That doesn't make me the best at it in the world. I have an appreciation for it, and this is one of my hobbies. This is something that I love to do and love to spend time on, and really like nothing more than that. I'm trying to figure this thing out the best way I know how, but by no means does that make me an expert. Like I said, I'm just an enthusiast, and that's all I ever want to be known for when it comes to this.
And all those things are true for me as well, but I know even less than Ryan, so don't give me any credit.
No way, man. Not at all. Not at all.
So Ryan's almost at 100,000 subscribers. That is expert status.
Right. That's how you
Yeah.
No, it's so true though. You know, people do see that subscriber count or whatever someone's clout, quote unquote clout is, and all of a sudden they think they're the, you know, either that creator thinks more of themselves, it's the ego that grows in, or their following starts to deem them as the expert, which also feeds their ego. It just can become such a dangerous game.
Mm-hmm.
And when you guys find yourself in that moment of question, I'm actually curious to know, like, Craig, if you hear someone who's talking about maybe it's SEO optimization, or Ryan, maybe it's you with, you know, more of the risk adverse dividend straight portfolio. Do you guys tend to chime in when you hear the clown in the suit trying to make a statement? Or do you just let them go and say their thing and, you know, whatever, you'll go on your own path, they'll go on theirs?
I go back and forth on it. You know, if I feel I can come in a way that's like a friendly way, and like, you know, if I have it just like a nice entrance point. I don't like to try to call people out, and, you know, because I could be wrong too. Like, I just don't like doing it in a aggressive or mean way, or like that, like, what do you call it? Like, know-it-all way. I don't like trying to sound like a know-it-all. And sometimes I'll be like, I hate to be that guy, but, you know, and make a joke or something and say, like, you know, I could be wrong, but from my experience, you know, this, or ask a question like, have you ever thought of it this way? Or what if that, did you think about this? You know, and I do that with SCHD on X all the time. Like, somebody else, like, and people say stuff that's way off all the time, but people don't read up on as much as I do. So that's going to happen, you know? So, and I think people sometimes appreciate it, and other people that are looking at it definitely appreciate it when I make a correction, and hopefully it makes the community better, right?
Yeah.
I think it's so key because, and again, your approach is what needs the approach that needs to be taken, because at the end of the day, we're all full of our own experiences, and who knows if we're right or wrong, and it doesn't even matter. It's one of those things, right? It's like the wife advice, right? Like, do I want to be happy or do I want to be right? Which one do you want? But I kind of, you know, I'm thinking about it, and it's like, I always think as a creator, if you have, you know, your head on straight, I feel like we do have a level of fiduciary responsibility to some extent. Like, you do gain a following, and sometimes when you hear something so absurd, I almost feel like it's a responsibility to tune in to the conversation at least.
You know, I don't know. I think if you were to do that, you would not get anything else done, because I think that if you look hard enough, you'll just find so many takes and so many things that you don't agree with and you think is incorrect. But like I said, I think you could spend an entire lifetime just responding to those types of things. And personally speaking, I really don't. I mean, I could go, just as an example, I could go on every single Yield Max video and talk about why I disagree with it, or I don't think it's a good investment strategy or a good place to put your money. But like I said, I would get nothing else done. And I'm of the opinion that not just with investing, but with a lot of things, if I'm right, then time will tell that. If I'm right, time will tell, basically. Time reveals all. And I think a lot of lessons we have to learn the hard way. And I think that the things we learn along the way, and the things we say too, it's all part of the journey and the evolution as an investor. And, you know, I could go back to so many of my early videos and just see where I said something wrong or had a wrong take, or, you know, said something that I've now learned not to be true. And I think I think if I didn't have those original thoughts, I wouldn't have been able to grow from them. But at the same time, like someone else probably wasn't going to be the reason that, like someone else trying to correct me in the comments or something, probably wasn't going to be the reason I learned a certain lesson. It was more than likely going to be from my own like learning on the topic or through my own experience. And I think that's that happens a lot with other people too in a lot of different areas. Does that make sense? I know that was kind of
for sure. No, I
not
guess I
worded
should
very
say
well.
like don't go seeking it out. But it's like if you catch wind of it, you know, or if you're just kind of scanning a channel or whatever it is, because again, it's like I always wish I had a me in my life, and that's why I started my YouTube channel, because I didn't have a me in my life. You know, I didn't have someone that was there to kind of say, hey, you don't have to do this, but you might want to think about this, or if you think about this, it might give you a better rationale or perspective.
hmm Yeah, and actually on that point, I have a concrete example for you. I get sent videos from time to time from, people in the audience who will send me videos on like why dividend investing sucks or like why SCHD is dead or, something along those lines. And, in those instances, yeah, I could go and drop a comment, watch the video, go drop a comment and explain my different way of thinking. But what's the point? I don't care what this other person thinks at the end of the day, to be honest with you. I really don't. It has no impact on me whatsoever. I'm just going to do me, whoever that is, to the best of my ability. And that's all I can do.
Ryan, that makes me think of. I would love to get your perspective on this too, because I've had some debates going on X right now. People saying that there's so many better options than SCHD now for income investors when you have things like the high income. And let's focus more on the ones I would call the better ones, like that aren't like 20, 30, 40, 50, 100% yield. More like the double digit, like low double digits, like 10, 11, like a SPY, QQI, JetQ, that sort of thing. I get a lot of people say like, I just sold, I'm done with SCHD. I sold it. I put it all in the QQI. I'm getting 14% and it's staying, total return on par with the NASDAQ with a 14% yield. And, what's your opinion on that? I have some thoughts, but I'd love to hear what you think. And Ari as well.
Man, I think on the surface, like if you can get a 14% total return, like a stable 14% total return year in and year out, you'll probably be doing pretty good over a long period of time. But I think when it goes to those type of funds, like that's the question. How sustainable is that? A lot of these, haven't really been around long enough to gauge that. But I don't know. I guess they can have a place in a portfolio, right? Like maybe kind of like what we were saying with an SCHD or any of these other things, maybe don't put all your eggs in one basket. But, if you're looking for some high yield exposure and that looks stable, then I think that there's probably worse things that one can do. Like, for example, the JP Morgan covered call ETFs. Yeah, I don't really particularly have an issue with those. I would rather get my income from companies that are generating profits just because that's more straightforward to me. But those, they've been around for a number of years. They've delivered solid total returns. From what I can tell, like the income from them has been pretty steady. So yeah, I think for what they are, you could certainly be doing worse. You know what I mean?
Yeah. Ari, what do you think? Do you have any thoughts on those, or that's just outside of your wheelhouse?
No, I definitely have thoughts. I think Ryan hit the nail on the head with suitability. Suitability is big. And I also think what people need to understand about a lot of these newer funds is they are vehicles, definitely vehicles to help you with income, but vehicles nonetheless that are more meant for intraday trading to some extent. And that's really important because they're not your buy and hold ETFs. And those are more of the traditionally minded, investors who are looking to buy and hold. And I think where we're getting a lot of confusion, and I see this a lot just working in the industry, right? It's like people think that with these newer ETFs, you can go buy and hold. And there's if that's your mindset with these newer ETFs, you're going to be in big trouble when you realize that they weren't created for buy and hold. And we can't fall trapped to that, which I think a lot of investors are because they are getting excited about the 60, 80, 100% distribution rates. And it's like, whoa, well, did you really take a look at that prospectus and what the fund's objective is and how to actually use it to your advantage? Because again, they're not buy and hold. Whereas your more traditional ETFs that were of, a decade or so ago, your SCHDs, those really were built to last.
Yeah. Yeah. And that's it. To me, it's just like, I like what Ryan said about it. Like, maybe there's a place for it, but I don't think you want to, like, people are putting this as like core holdings. And I'm just not sure about that. And it might turn out to be just fine. But these things that are so new, I don't think it's a good idea to like put a good significant portion of your portfolio into them just yet. But they do. So far, so good. They've looked good, but over an extended period of down, we don't know how they're going to operate. And definitely the ones that are like over 20% yield, like that's more leaning Ari to what you're talking about. Like these are more, these are trading tools or for like a specific type of investor. I'm not even sure who, but somebody that maybe already has money and they want to make money off that money and like have it slowly erode over time because they want to die with zero. I don't know, but yeah, SCHD is not flashy. Some of these ETFs that have been tried and true, they're not flashy. They're not sexy. They don't yield super high. They don't return, super high here and there. Like, it's just slow and steady. And then, but if you think about like some of the greatest investors in the world and like all the stories you learn as a kid, like the hare and the tortoise, what's the lesson behind all of that? It's always take your time, steady. It's the steady and the slow way that builds success. And to me, that's just, we can't forget about that just because something's shiny and new. And it looks great at the time, but down the road it might not be so good anymore. So it's nothing wrong with sticking to a little tradition sometimes, right?
This just brings up, I had a really good friend of mine, and I have been having some chats recently, and he's got a lot of life stuff going on, but I had like a slew of voice notes on WhatsApp from him today. He's just going nuts. He's like, my job, this, that, this is not right. I want to do this. And I said to him, I said, man, you might want to take a breather, like maybe open up your palm, take a breath, right? Like just everything from the outside, like looking in looks great. And you're in the inside right now in this hot flame. And he was just freaking out. He was going nuts. And, a couple hours later, he actually sent me a message like apologizing because he was a little like just off the out of the deep end, if you will. Like, I don't even know where this guy was going crazy. But to Craig's point, it really is. It's like you have to be able to prospectively look that long-term picture and realize that sometimes, even if you just move an inch today, that inch was not only all that you needed to move today, but a sufficient amount for you to actually comfortably sit and retain the information or, the energy that you have to keep going. Because if you torch that candle, if you will, well, you just torch the candle instead of lighting it. And people, I think, go a little too crazy, especially with investing. And right now we're at this very interesting point where ETFs are literally about to overtake the amount of individual stocks that are out there, which means only one thing. Not all of those ETFs are going to be your, triple grade A stocks or rather investment vehicles to get you to where you want to go. And you're going to have to do more homework on them. The more ETFs that come out, the more homework you should be doing because they're not all, the fabulous ETFs that these companies are pitching them out to be.
Absolutely. Yeah. There's so many of these different income strategies coming out now. And it's like, they just can't all be good. And you really got to look into what happens with like, how much are they charging you to hold this? What's going to happen over time to your actual money that you put into it? Like not just the yield that you're getting back. And will that actually make up for the money that you're losing in the NAV, the difference between the actual value of the holdings versus what it's what it's trading for, I guess. Yeah.
You know, that made me think, like, is there ever a point where that caps out, like, or reverses, where there's just too many ETFs? You know what I'm saying? And there's not as many coming out onto the market, and maybe people lean back towards individual stocks. Or I guess what I'm trying to ask is, do you think there's going to be any sort of reversal there, or is the cat out of the bag and you can't put it back in? You know what I'm saying?
Yeah,
I don't think you could tame the cat once it's out. I think you can get a different cat though. So I think Wall Street is very good.
Don't say that too loud.
Oh yeah, I don't. He hasn't come into the screen today yet, so I.
No, I think he's out down on the strip right now. He's out.
He heard the comment already.
Yeah.
No, Wall Street's great. Like, it's a game of sales, and right now ETFs are hot. Right now ETFs are great vehicles, to get people to where they want to go and to where they need to go. And just know that for every investor, there's a great listener out there who's listening to, unfortunately, a way to sell you. And that's why Wall Street, a lot of the time, gets the rep that it gets, is because not all, brokers out there on Wall Street are, what do you think, they're working for you? They're out looking to make their own dollar. And that's where it gets really it can get really, car salesman like. Even car salesmen, it's the same thing. Anything with a salesman in it can be dangerous territory.
Yeah, it's the incentive, right? The incentive is to how you got to look at all the time. Like, what is the incentive behind what they're doing? And they want more people to buy into their ETF so they can make more money off it. And then that goes back to what we're talking about, somebody that actually is an expert in the underlying, funds or the underlying stocks. It's often not. It's often a salesperson who's been told the talking points and the rebuttals. I've been in sales, and that's all they know. If you were to continue to dig, you might find that they don't know as much as you think they know about investing. They just know what they need to know, right? Like to get by in a 15-minute interview, right?
I think at the end of the day, if all these new ETFs coming out just end up, being what we say they are and think they are, which we could be wrong, right. But if they all end up being kind of like that, where they're more designed to generate fees for the managers than or wealth for the managers than for the people who actually own them. If people get burned by this stuff enough, I just wonder if there's going to be some sort of consolidation to where people then start getting back to basics, and there's even more of a flight to the VOOs, or the, long-term dividend funds like what we've been talking about here. I just wonder if that's kind of where all this is headed at some point. Like at a certain point, people just get hip to the game, and that's what causes them to think long-term. I don't know. I'm thinking out loud here,
I just looked at just the other, like I bought some cruise stocks a while back, right? Like probably during the pandemic. And I was just thinking, like, I don't know which one of these in the end is going to do better than the rest. Maybe I just sell and then consolidate to an ETF. So I looked up the ETF. Is there a cruise line ETF, right? And I found all sorts of links. But guess what? Every time I clicked it, that page was dead. I think the ETF for cruises is no longer exists. Mm-hmm. So that kind of speaks to exactly what you're saying. At a time that was trendy, and I read articles and they're like, hey, cruise lines are doing amazing right now. And it was like, I don't know, it was like 2022, they're having a comeback. But then now, like recently, they're going up and down like crazy. But it was trendy at one point. Like, let's get the dates out of it. Just say at one point it's trendy, at one point it's not. So when it wasn't, they stopped it. Maybe they need it again because it's coming back. But we don't know. And that's what happens. Like, there's so many of these trends, and somebody jumps on. I remember there's even a study done, particularly, I think, maybe it was, I shouldn't say a study, more anecdotal on the round hill. And I know you may not want to mention it, speak badly about it or not, and I'm not necessarily speaking bad about this either, but somebody said that every time Roundhill comes out with something, that's the top for that theme, because they tend to follow the trends, right? But then once they've had it takes time to get these things going. So by the time they get it going, the trend is probably over, because that's how quickly these trends go. And I always look for that. What's the sign at the top? Like, what are things like when,
Yeah.
when regular people start talking about a certain trend, or, that people that don't follow it, like when it hits Good Morning America. When I see something on Good Morning America, like the regular kind of like fun and poppy news, I'm like, oh, this might be the top. It's often a time of like, okay, you might be able to jump on, but how much more of this trend is left? And that again goes back to, do you ride a trend, or do you buy when things are out of trend and ride the wave up or ride the wave down? Like, time frames really matter, like, and the type of trader you are. And you can win at all the different kinds. You can wait till something's completely on sale, and maybe you win, 55% of the time if you get it at a good time. You could also ride a trend when it's high and know when to get out. But to me, it's harder for me to ride something when it's high and know when to get out than it is to see something good that and it seems to be on sale, or at least cheaper than it has been in the past, and able to just buy that when it might have been good to buy when it's high anyways, because it's quality, it's good. So it's just better when it's cheaper. So I choose to kind of invest that way, but there's nothing wrong with somebody that can watch the charts and keeps an eye on all the trends and what's growing and what's not and what's going to fall off. And that to me is a lot of work, and it's very hard, and it's very risk reward. And if people want to do that, go for it. But if you got to also realize yourself, you might not be able to do that as well as you think you can. It's easy when everybody's riding high, but when things change, man, it's tough. It's really hard when that trend is over and you're still in it. It sucks. It really sucks.
And it's a totally different type of decision making too. Like, you're looking at like someone who's maybe momentum trading or something more short term, they might not even know what the businesses that they're buying do. But for what they're doing, that's fine. They don't need to know that
they
stuff.
Don't care.
And so
they don't care.
I guess, so I guess that's just what it boils down to. We're doing different things. We're playing a different game.
Right.
Yeah, this is why I love the deep end, because I don't know if you both caught it, but we first came out of the gate asking the question, like, when does the trend become the foe or remain the friend? And I just got my answer really from Craig. When Good Morning America starts talking about something, the trend is no longer your friend and you should run. But this also reminds me of the time, which was back also during the cruise stock bonanza, because I also invested in cruise stocks. I invested in Royal Caribbean, and I held that puppy until it rebounded, and I made a hefty sum from that. But again, you had to wait a decent amount of time before that stock or those whole, a bunch of them popped off. SPACs were also big in 2020 and 2021. Everybody was investing in SPACs.
Tell me about it.
And I remember one of the last SPACs that was like as hot as can be was Bill Ackman's SPAC. And Bill Ackman came out hot, and he's like, I got this SPAC, and nothing happened with it. No one invested in it. The trend was over. And you just got to question, like, you got to have your head in the game. Because if your head is not in the game and you're just chasing trends, you're going to be in for a real treat.
Yeah.
Well, on that note, I think it's safe to say we probably won't be seeing SCHD on Good Morning America anytime soon. And maybe if we do, we have another one of these roundtables to figure out how best to proceed. Because I think we'll be in trouble.
Yeah. I won't be selling, but I might not be buying anymore at that time.
Well, if anyone's going to be on that show talking about it, I'm sure it'll be you, man.
That'd be funny. That'd be funny.
Well, fellas, I think we're about an hour 15 into it. I think this is a pretty solid place to wrap it up, unless either of you guys have any last words for us here.
I'll throw a couple last words just in the ring. It has been such an honor, really, Craig, to have you join us in the deep end. And we knew it was going to be a good conversation. I want to really extend the opportunity to everybody out there listening. Go ahead and comment down below with what you thought, what your thoughts were on the entire episode here, SCHD related, the trend being your friend or the foe. We want to know what exactly your thoughts were throughout the episode, and definitely subscribe to the Deep End to really join us each and every episode. Ryan, I'll toss it back over to you. Those are my 2 cents.
All right. Well, yeah, Craig, thank you, man, once again. I'll be sure to put the links to Craig's Twitter. I'll even put your Blossom on there. I know you said you weren't super active on there, but I'll put it in the description, the show notes, and all that stuff so you guys can check them out. But with that, my friends, really fun episode. Thank you guys all for tuning in. Craig, thank you once again. Ari, thank you, man. Really fun to get together with you guys. Craig, hope to see you back on here sometime soon. But all you guys, once again, thank you so much for tuning in, and we will see you in the next episode of The Deep End.